Hope you're uh, enjoying the wet weather we're having. I like a little rain coming from Seattle, but driving 3 hours in the rain yesterday was not fun. Let's go ahead and get started. So we're going to have our normal agenda as we always do: the market, treasuries, economy, Fed, alternate investments, and the takeaways. Jumping into the market, we've had some volatility. This is a year-to-date chart. We're pretty close to that price today, even though the market was down yesterday and then up today. So all in all, year to date, we're down about 4.5%. I do think this is a trend, as we've talked about for months and years, even with some of you. I think we've kind of finally hit the tipping point, as I've mentioned many times, and hopefully you'll see an email in the next few days about this. We've ripped off the Band-Aid. And what I mean by that is there's been a ton of hidden information, false information, regarding jobs and the economy and all of those things. And now they're starting to be exposed. And frankly, it's starting to drive the market down, which it needs to do for our economy to be strong. We need things to be valued in a way that actually has some logic behind it. So, as we've talked about for a long time, this market needs to come down. It's finally starting to do that. And we're finally starting to see some of the major companies downgrade their expectations for the year. So they still have positive expectations on the market, but lower positive expectations. And typically when you go through a cycle like this, they start being a little bit cautious and then a little bit more cautious. And then eventually they say all hell is breaking loose. So I think we're probably a few months away before we start to see that, but we're starting to see cracks in the bullish facade that's been going on for years. Okay. 20-year treasuries, again, you'll see the overall trend on the yield is going down. And as a reminder, when yields go down, bond values go up. So through this year so far, we've seen the long-term treasuries go up in value, which was our expectation. Along the way, one of the things that we've talked about is whether the Fed cuts interest rates or not, we're likely to see interest rates come down as people go towards safety. We are seeing that occur. So year to date, we're seeing the values of those treasuries go up. I want to say we're up somewhere north of 4 or 5% year to date. Okay, next. So stocks tank as Trump declines to dismiss recession risk. The reason I put this here was there's a lot of talk about Trump and his tariffs creating a recession. And number one, I don't think it's tariffs or the discussion of tariffs that is causing a recession. That being said, I believe wholeheartedly that Trump wants a recession, a very short recession, to get things fairly valued again, to get the Fed on board with cutting interest rates and allowing companies to grow in a way where they're adding jobs. So this is a bit of a misnomer, this title here. But what we are seeing is, I believe, a strategic, as I said before, ripping off of the Band-Aid. So you may remember we looked at this chart last time and it showed that the VIX was likely to start going up. Um, in fact, if you look at it, I believe I added another slide. So the VIX, as of the time I looked at this, was up at about 24-25%. So it's up near its last peak around this time last year. So I do expect that we're going to see that happen. And that's where you're seeing the volatility in the market to the downside. I think this time it continues for a longer period through summer. And the expectation is that we have a drop in the market and that it happens within this calendar year, that we hit a bottom and start to recover back. Yeah, so we're seeing that happen. I do expect, as we've been talking about again for years, that this is finally where the market is gonna get back to fairly valued. Okay, next. Yeah, so it looks like the VIX was actually up at around 27. So we're up higher than it even showed on that chart for March. Okay. Long-term tips, again, you'll see the yield has the year-to-date trend of going down. I do expect that to continue. Again, yields go down, bonds go up. So to give you an idea, the market's down 4.5%. The all-weather portfolio on average is up anywhere from 4 to 6%, depending on your total allocation so far this year. So we're in the positive despite the market being down. And I anticipate that to continue through this calendar year. The Fed is kind of holding steady. They don't want to lower interest rates. They're worried about inflation. Just this morning, we got a lower than expected inflation number. Well, lower than expected by the people that talk about that as an expectation. I think we're going to see inflation drop and at the very least hold steady as the market starts to come down. And it's going to cause a reaction from the Fed, which would ultimately be to cut interest rates, which would again speed up the value of those long-term treasuries and tips. Okay, gold has been at or near its all-time high for a few weeks. I do anticipate that will continue. Again, if we do see the market drop in value, you're going to see a flight to safety. That includes the precious metals. So I don't think we're done with the growth here. And you'll see back in November, we were at 2,600. We're at 28.91. This is as of a couple days ago. And same with silver, not at all-time highs, but recent highs. And I do anticipate that this will continue to go as well, same as the gold, as we have a flight to safety. Okay, so the biggest takeaways are, number one, everything that we've been expecting and planning for is falling into line with what's happening. Um, Market's coming down, interest rates are coming down. I said it. And we're seeing an overall trend in the industry towards reduced expectations for the stock market. So, all in all, I'm very happy with where we are, how we're invested. Um, Again, the things to look for, we've talked about this on past meetings. I do still expect that we could see bonds and gold and silver come down when, for lack of a better term, the you know what hits the fan and everybody starts selling out. And that's an opportunity to switch what we have in the short term treasuries towards those assets at lower levels. So all of that being said, I'm very happy with how we're positioned at this time. So any questions?
I think in the past, I've heard you say that you believe the stock market is more than valued at more than twice what it should be.
Yep.
So where do you expect it's going to go to as it drops?
Well, it depends on what you mean when you say the stock market. So generally, when I refer to the stock market, I mean the S&P 500. Um, that being said, you're going to have certain sectors that are going to be down likely 50, 60%. Things that are extremely overvalued ahead of where they should be, meaning there's expectations. So, for example, AI, a lot of the AI companies that are up right now are up based on what potential they have sometime 2, 3, 4, 5 years down the road. People are willing to pay for potential when things are good, and their willingness to pay for that potential drops significantly, and their risk on that drops significantly. So I do think a lot of those types of companies, probably not the bigger names, but the smaller names, you'll see significant downside there. Um, Overall, I think we could see the S&P down 50% from its high. So that's another 45% from where we are now. Um, and frankly, that's why we don't invest very heavily in the stock market when the market is overvalued, because you can get good returns not being in the stock market. You can't avoid big downside if you are in the stock market. So um, we have some big opportunities coming. I foresee, and I think it's going to be before the end of this year. Hope that answered your question.
Yeah, thank you.
Yep. Yeah.
What is the VIX, the VIX?
Yes, that's the volatility index. So it basically measures the ups and downs in the market, and the more volatile it is to the upside and to the downside, the higher that number is. So historically, when it gets above 25, that's a significant measurement. So that's where we've been the last couple days.
Okay, thank you.
Yep.
Hi, Matt. When we're talking about potential upcoming recession, what how do you define recession? What does that mean to you?
Slowing of the economy, shrinking of the GDP, and just to be kind of broad, GDP is everything from tax revenue to consumer spending, all of that, both government and individual level. So I do think that's going to be reduced over the next 12 months. And I think the jobs cuts at the government level is part of that. I don't know that it's possible, but I'm hoping that the last jobs number, which showed manufacturing jobs rise by 10,000, where we've had manufacturing jobs drop for the last couple years. I think that's a positive trend. I don't think it will overcome the level of layoffs at the federal government level at this point. That being said, we have over 2 trillion in corporate investment that's coming into the US, investing in new factories, which again, there's going to be a lag between the time those factories open and people have jobs to where we are now. So that's kind of the period I'm looking at where I think we'll have reduced overall spending. That being said, I think the current administration is going to try and even that out. So it's never good to have a bad Christmas period. People don't like reducing their spending at Christmas. And one of the things that's been thrown out there, and I don't have any feeling on whether it's going to happen or not, is the Doge dividend, which if they realistically cut the government expenses, they could send out a check to tax-paying individuals sometime in December that would offset some of those recessionary pressures. Did that answer your question?
I was looking more for a measure, like how do you know when you're in a recession? Is there a percentage of slowing down, or
Yeah. Well, yes. So the definition of a recession is 2 quarters of negative growth. So there's not a percentage tied to that, but where it becomes a depression is where there is a percentage tied to it. So negative growth, jobs, unemployment numbers being, I believe, above 10%. And then I want to say it's a 20% reduction in overall GDP. And that's when it becomes a depression. So I don't think we'll get anywhere near that. But I do think we're going to have negative growth for the next couple quarters for sure.
okay, thanks.
Yep.